Thank you for joining us today. My name is Mark Feld, and I'm the Managing Director of the Riverside Experience. We are a division of Riverside Abstract, one of the large East Coast title agencies. So we have a very exciting program today and a very interesting topic that we've been getting a lot of requests for more information as this industry is moving very quickly. So I'm going to just give a brief introduction to each of the panelists, and then I'm going to allow them to actually jump in and just tell the audience a little bit about who they are. So first, we are joined by Akiva Gottlieb. He is a finance broker at Lev Capital. So Akiva, why don't you just briefly tell everybody who you are and what you do?
Everybody, appreciate the opportunity here. Thank you, Mark, for putting everything together. But just to give a quick introduction to myself and our team at Lev Capital, my name is Akiva Gottlieb. I'm technically a commercial real estate mortgage broker. What separates us from the other guys on the block is that Lev has, combined a team of experts in, commercial real estate finance, combined that with, the top of the art technology in the industry. And something really unique about our firm is we've created this lender analysis that, based on a particular deal with every unique variable in every deal, the geography, the tenant structure, the asset class, the specific asks that your borrower will tell, we're able to plug that into our system. Each variable plays a different role in weighing the proper lender to come out, and then a list will be generated of the appropriate lenders for this particular deal. We apply this technology to every single deal that we take on. And in an industry like cannabis, where things are extremely particular, as we're going to get into in this conversation, it's been extremely advantageous for us. And that's how I got into the space. And I'll share a little bit more about that later on.
Fantastic. Next, we are joined by Dennis Baranowski. So Dennis, why don't you jump in, give us a little background about yourself.
Hi, everyone. And thank you, Mark, for inviting me and allowing me to participate in this today. My name is Dennis Baranowski. I'm a partner at Jurasi Law Firm in Irvine, California, and I work with the firm's banking and finance group. Our firm is a full-service law firm dedicated almost exclusively to private, non-conventional lending. We assist our clients in every aspect of their business, from licensing and compliance to raising capital and securities compliance, documenting loan transactions, loan sales, hypothecations, participation, servicing, as well as lending compliance. Also we have a litigation team that handles our creditor representation and general litigation as well. Over the last 5 years, I've developed and managed our cannabis lending practice, and over that time, I've assisted numerous private lenders, mortgage funds, and credit unions with respect to underwriting, processing, documenting, and closing loans to cannabis businesses or property owners with cannabis tenants. And I'm just really honored to be here and to participate with this great panel that we have here today. Thank you again, Mark.
Excellent. Next, we're going to go to Sandy Cronenberg, Managing Partner at Co-op Capital.
Hi, Mark. Co-op is effectively a private equity fund that focuses on retail properties in the cannabis industry. We're on our third fund right now. This fund we just raised was $100 million. It's a serial fund with which we deploy across the United States for MSOs or operators who we acquire their real estate and lease that back to them. And, we've been at it now. In our first year, it was at about a 15% for the capital. Then it was 13%. And now that we're getting access to leverage when banking is coming in, and we're able to just continue to drive the rates down, I wouldn't be surprised if next year we're in the single digits exclusively.
Fantastic. All right, next, let's go to Aaron Herzberg, founder and general counsel at the Puzzle Group Law Firm. You just have to remember to unmute yourself.
Got it. Can you hear me now?
Sounds good.
Fantastic. I'm Aaron Herzberg. Mark, thanks for inviting me to join. I'm a cannabis business person, I guess somewhat of a cannabis real estate developer in the retail space. I've been involved in California cannabis for 9 years. And I've obtained many retail licenses, and I focus on the acquisition, both leasing as well as purchasing real estate for retail dispensaries. And I work with some of the larger national operators to assist them with obtaining the real estate and obtaining the entitlements or winning the licenses, which are highly competitive. Thanks.
Right, and lastly, but one of the people that I'm most excited about for joining us today, because it seems like we have a really full panel covering a lot of the aspects of the cannabis business, is James Thanasoulis, who's the Senior Vice President and Chief New York State Counsel for AmTrust Title Insurance Company. So James, it's great to have you. Why don't you give us a little intro or bio about yourself?
Good afternoon, all. Well, title insurance is my background. I've been doing it for about 25 years now. I was previously at First American, and then I came to AmTrust about 6 years ago. AmTrust is a casualty insurance company that decided to open a title insurance branch a few years ago, and that's where I came in. We were doing well, we're evolving. We could issue any single policy of $525 million. That's our policy limit. And one of the things we've been dealing with is cannabis and whether or not we can insure it. And being the new kid on the block as a title company, so we get pressure from clients and they're saying, AmTrust, step up to the plate, insure these things. So that's our struggle. That's what we're trying to figure out, how to issue these policies with minimal risk and minimal exceptions. So that's why I'm here today, to listen to the panel and get their take on it, and to help form a more informed decision about insuring the cannabis transactions.
All right, fantastic. So now I'm going to give it over to Akiva and Dennis. We're going to co-moderate, and thank you all again for joining us. And I'm excited to I have a lot to learn, so I'm excited to listen to this.
Yeah, I'll jump right in here. Thank you, Mark. I appreciate that. And this is all about a conversation. There's going to be lobbying. There's going to be protesting potentially. And it's great to have everybody on and really an opportunity to learn from everyone. And to start this thing off, right when Mark reached out to me, I said, we got to get Sandy on. Sandy personally has educated me in numerous, elements of the industry, really got me going and hyped up on the potential upside in the industry here from my perspective, as well as investors on the ownership side. But really to kick things off, Sandy, as a directed question to you, when you considered becoming an owner and an operator for commercial real estate with cannabis associations to it, firstly, what elements in the cannabis industry and its history particularly, stood out to you and were important for you to understand before taking this thing on?
So this industry is a hyper growth industry, and many people throw out numbers of compound and annual growth rates of 30% or more, but for real, the statistic that sold me, and to the point where as I've put forth a significant portion of my own wealth and have now created these private equity funds with which we're providing double-digit current pay to our investors with a 20% plus IRR, is the fact that this industry has way beyond the growth rate and or the percentage of people that we originally ascribed. Our modeling was showing that we're about 20-25% of a population, but we were blown away when the industry's BDS Analytics came out and said in the state of Colorado, and Colorado is the first state that legalized recreationally, this year the state of Colorado has an average consumption rate of north of 43% of adults visiting a dispensary on a monthly basis. It's astounding. And so basically that's saturation. Think about it, you're having a party, or you go and pick up booze for that party. Do you get it? Do your wife get it? Your friend gets it? Right? So the point is that in my mind, that's pretty much saturation. And so right behind that, you've got California, which is at 37%, which legalized just after Colorado. And what we're seeing is across the United States, those same trends are occurring. And we're seeing the same supply and demand constraints with regards to when a new state is now licensed, and then what Aaron deals with regards to the entitlements and all the battles that get fought over those properties, and then pulling Dennis in to help make sure that people acquire these properties and have operators to handle that whole vertical stack, because you need to control your own supply and demand to make sure that you've got product in your stores and that from a 280E, a tax perspective, you're profitable. So we come in and we're part of the capital stack. Co-op basically buys the building to be able to provide the funding, but I need to do so in the most secure way possible. But our MSO partners, the operators, the folks who grow and process and then eventually sell that product, it's a hyper growth industry, and all of them are doing really well. And we have structures in place that are way more secure than any other triple net lease from like a Starbucks or a CVS.
Wow, astonishing statistics, and appreciate that for sure. I think for now, I'll turn over the mic briefly to Dennis for the following question.
Yeah, actually, Sandy, I was just wondering, kind of what assurances have you given to your investors with respect to the whole conflict still existing between state and federal law? Do you still need to, and actually, do you still even find that you need to explain that conflict, or is everybody kind of educated now?
So it's a great question, and we address that on a number of different levels. So from the first perspective, this is a real estate transaction. So we buy a building, and it's a very safe transaction in the fact that not only are we getting corporate guarantees, and we've got really strong NOIs to the point where DSCR isn't even a consideration because we blow out of the water most retail type of concerns, but you have to get back to, okay, what are the risks here? And quite honestly, we've gotten legal opinions from the largest real estate law firms. We're not subject to 280E, so there's real no concern there. Then when you look at some case law that's been set forth, now there's no bankruptcy protections, right? But in all of cannabis, but the thought though is you look at an example of the Guild, and the Guild was a operation in California, Southern California, that failed to pay a note. And the judge looked at it and said, look, this is like real estate like any other, put it in receivership, went to auction. That auction yielded an $8 million purchase. Now, what's the point of that? Well, the value of the note was $1 million, but the value of the purchase was $8 million. Why? Well, because in most parts of the country, these retail locations, and now if I include the operation, the license, and the real estate, typically trades all three for 1x. And so that's 1x revenue. And so that location was doing about $8 million in revenue. And so you basically now see that it was foolish for the Guild to have not found some alternative, because they squandered that value. And so we have this partnership with our MSOs that we're mutually beneficial to make sure that if for some unplanned reason that business fails, that they can convey those interests, because they're not interested in losing that value. And so they can convey it to another operator who may be more capitalized or better suited. But the point is that license, that building, and that operation can be typically transferred to as 1x value and of what that revenue is, which far exceeds the retail lease that you would otherwise expect. In a typical retail lease, it's about 10% of the operating expenses go towards paying the lease. In a cannabis operation, it's only 5%. They're doing that much revenue per square foot. So these are extraordinarily safe vehicles. And on top of that, there's a whole line of people who are willing to pick up that license because of the entitlements. And Aaron can go into that. It takes years. The supply is not keeping up with the demand, and the supply of new retail licenses. I honestly think we're in the second inning in terms of the built out of the number of dispensaries across the United States. From a specialty real estate interest, this is brand new still. I mean, I know people have been in it for years, but there's so much, there's billions and billions of dollars of real estate that will still need to be purchased for retail, and to be able to provide the supply that eventually will be coming online across the country.
Excellent. Love to hear the industry's continuing to grow. It's just been a phenomenal ride thus far. So I'd like to ask, turn to Aaron, and if some of our listeners are interested in franchising a top cannabis retail brand, or even opening up their own dispensaries, how would you begin to walk that person through the complicated zoning process and potential hurdles and obtaining an operating license?
Okay, well, that's a long answer. I'll do that in a short version. I have 30 projects going right now, retail dispensary projects. Some are approved, some are not. Each is in a different municipality. And California is not unlike some of the other states that are just starting to come online, including New Jersey, where we're seeing that cities are each sort of determining on a municipal level, standards that are very, very localized. Now, there are some states that have more centralized sort of systems, but I've worked in the states such as California, such as Michigan. Now I'm starting to look in New Jersey. I certainly don't have any idea what New York is doing, but I know that in many cases, the local municipality is going to set their own criteria. Are they going to allow cannabis uses at all whatsoever? We're seeing that New Jersey, there is a 180-day period from the passage of their regulations in which cities either have to opt in or out, and many are opting out. Potentially, they say they're going to opt out and maybe revisit it later when they have more time. So initially, you're going to see many cities opt out in many of the jurisdictions, and then slowly come back into the mix. There are typically very common sensitive uses. So the properties that are used, whether it's for retail, whether it's for cultivation, manufacturing, they typically need to, the cities require or mandate, as well as the state, that they be a certain distance from schools. In California, that's 600 feet typically from K through 12 schools, from daycare, licensed daycare facilities. Then each particular municipality decides sort of on their own local criteria. Some add churches, some add youth centers. Each one has different definitions. So the way to work this is really always work within your local community that you're seeking to enter, and make ties within that municipality. Speak to the elected officials, the board of trustees, the council members, and get in early. The early bird always gets the worm. So honestly, I don't like saying this because I'll see many competitors, but honestly, if you get into a city early, you track it early, typically you're able to understand where the so-called green zone is, or the map of zoning. And when you do that, you're able to kind of find the best retail properties, which is the part that I'm in for retail. Of course, whether you're looking for cultivation or manufacturing or warehouse or even just a greenhouse. So getting in early, speaking to local officials, speaking to community groups as well to understand sort of what the oppositions might be to your location. And then just in general, understanding the method of selection. Many of these cities and on the city and state level have a merit-based criteria. And oftentimes they hire outside consultants to score the application. I'm a big believer, being a lawyer as well as a cannabis business person. I'm sort of like extremely anal, and I believe in overkill. You can't overkill your merit-based application. It's just not possible. So put a lot of work and effort into ensuring that you're going to basically win. I compete regularly in jurisdictions where there's 50 applications for 2 or 3 or 4 spots. Sometimes there's 15 applications for 1 dispensary license, and we routinely do well. And that's by understanding sort of what's being asked for, forming the political relationships. So that's kind of a little bit about that. Also, in general, in terms of the opportunity for real estate investors, I would say that the rate for cannabis leasing tends to be 2 to 3 times the market rate of that property. Typically, we engaged in a lot of purchasing because there was a concern on the part of owners that banks would call loans. However, since COVID has taken place, I'm finding, particularly in retail, not in warehouses, but in retail, that the market is very soft. And so we're able to get better locations through leases. And so it's less, likely to be able to purchase and more likely recently to lease because there's so much availability for leasing. But that changes over time. So that's kind of a little bit about that.
Yeah, and if I may add to that, though, from the day that entitlement process starts to the day you're selling your first product, it's typically about 2 years. I mean, you're in it for the long haul. And so you need to find very patient capital partners. But also with that entitlement process, you're better off not actually leasing it from the current owner, and you're better off getting an option to own that property. And that option to own that property, or finding a partner like us to acquire that acquire that building, you're better off because, number one, we have the financial institutions who are comfortable against it, and you'll never have to worry about the wool being, the rug being pulled out right from under you. Title work is important, and then of course drafting of the lease, because your typical real estate cannabis lease is not your traditional retail lease. There's a whole litany of provisions in there that you want because of how limited that licensure really is. And so that's really important, and being able to craft it such that you've got the flexibility. One example, the building burns down. Most leases, you're out of the lease. That's not what you want. And you're mutually aligned with the owner and the tenant to rebuild that thing as fast as humanly possible, right? Because you very often, if you're lucky enough, you have a good enough relationship, you only have a temporary ability to move that license and hang a shingle down the road. More often than not, it's to that address, and you just can't move that entitlement before you could rebuild it.
So I want to comment back. I do agree, and then I don't want to take up 2 hours explaining the thing, but yes, it takes typically a year to a year and a half, sometimes 2 years to entitle these properties. So you've got to work with a landlord. So I take your comment very, positively, that you have to work with a landlord who's going to be open to this sort of flexible entitlement period. And in terms of what we do in those scenarios, I'm a lawyer. I have the advantage of being able to use various tools to lock down the real estate. I use options to lease. I use options to purchase. I use various legal tools to lock down a property without committing, so that in the event that the license is not obtained, which unfortunately is somewhat likely, then we have a way out, and we have a way to mitigate our losses, and that de-risks it for someone like you who's lending on or financing the property.
And actually, and as kind of a follow-up, I'd be interested to hear, Aaron kind of mentioned the strategy from the tenant standpoint of what he does to protect against in the event that a license doesn't come to fruition. See, kind of what strategies do you look at with respect to, obviously you'd mentioned it usually takes 2 years from application to selling the first product. As a landlord, what do you do with that property for 2 years? What are some things that you do to realize some type of return for your investors during that time period?
So yeah, no, that's a great question. And quite honestly, we like to get involved as soon as Aaron's group gets the license, right? So as soon as they get the license, then the value is there and it's built in. And now you're looking at getting creative about that. Sometimes, Kawak, we have to literally build from ground up. Sometimes it's a rehab, sometimes it's an existing facility that all they need to do is hang a shingle and they're off. And so we've got flexible options on how to include, because as soon as you sign a lease and we provide the capital, our investors, our LPs want to start receiving current pay. And we're happy to do that. And so we have to, of course, build that in. And so the day we sign is when the day that the lease starts, but you can effectively pick it. And by pushing off of that and nesting that into subsequent payments over time, and or of course, providing the capital that they then would use as part of that payment, as well as the tenant improvements. And so we can get creative. We're not some draconian bank that does this AIA and it's the drawdowns follow this meticular construction type loan scenario. We wish to be much more friendly than that, but we do have solves. The instant you get a license, you reach out to us and we help craft what the capital stack that you would need is. Like, again, we're not the only answer. There's the debt folks, there's of course your equity and all of those equity investors, sale leasebacks, plus there's sale leasebacks on the pure cultivation side. We'll do retail and we'll consider verticals, so where you've got cultivation and or processing and that retail, but we don't do cultivation only. But there's other folks who do the cultivation only, and then there's equipment financing. And so the aggregate of all of those together usually provides a solution.
Excellent. All right. Akiva, let's move back to CRE. And being that there's such a wide range of deals on the spectrum of cannabis real estate, from new venture growths to publicly traded companies and their state-of-the-art facilities, what does the commercial lending environment look like today versus a year ago?
Super weighted question, but since you mentioned the year mark and timeline, I think it's easier, and Mark emphasized to us that we should, shed personal experiences and talk about, deals that have happened in the past. And to take this thing a year back, and I'll start with the story of the deal of our first cannabis deal that we closed, and then I'll walk through the different tiers of financing available today versus a year ago. But about a year ago, we were, as a commercial real estate debt brokerage, we take in deals, the same regardless of the asset class and the tenant structure. So at the time, I was a little bit naive, and because the industry is expanding naturally, we started to see a couple of cannabis deals come in. Some of those look different than others, like you mentioned. We've seen, believe it or not, deals that really are grows from a basement, from somebody's basement, literally, versus state-of-the-art facilities, like you mentioned, with REITs that are beautiful facilities, state-of-the-art industrial Class A, consideration. So we got a deal, and it was a cultivation facility with a top MSO in Denver, Colorado. So it's industrial. It had brick and mortar. It was pretty. It was somewhat renovated in the past. Without knowing much detail about the history of the property, we took on the deal. And I was naive. I plugged it through our lender analysis. Like I mentioned, Lev, one of our unique things is that we built this lender analysis. So we plug in particular variables of the deal. We mentioned that, cannabis tenant is involved, but at the time, our technology wasn't sophisticated enough to really understand what that means. And it spit out 3 lenders, one of which was the existing borrower's, mortgage holder from a debt fund. The other one was just recently added because a colleague of mine, was lucky enough to bump into a bank that said something along the lines of, we lend on anything, even cannabis, something like that. And lucky enough, I didn't know what to do. I sent that deal straight to that one bank in Boston. They underwrote the deal, and along that process, it was quite a long process, about a 6-month close, I was able to learn about exactly how difficult this thing is. That deal ended up closing from a federally insured bank. It looked just like your standard conventional loan, 4.5%, 5 years fixed, 25-year AM, non-recourse, 65% loan to value. And it's important to highlight that loan to value is a very vague term. And I think we'll get into that a little bit later on. It sounds super pretty, but yeah, Sandy's laughing. That number is a little bit inflated and unclear, but we'll get into it. So that being said, we've learned a lot in the past year. I mean, our lending pool, which started off from 3 lenders, like mentioned before, has now expanded to over 60 lenders. And the way I explain it to when we get in a deal, whether it's, a really pretty real estate deal versus a new venture grow, I say it the following way. There's about 4 tiers of lending in the commercial real estate lending space for cannabis right now. Of course, there's primarily and optimally, of course, there's certain variables that will knock this out, but there's a bank, it's either regional, state-driven, chartered bank, sometimes even nationwide. We're starting to see some more banks get into the space. So those banks, those terms will look conventional. Like I said, sub 5%, 5 years, 7 years, 10 years fixed, hopefully 25-year AM, if not 20, and sometimes they'll flex it to 30. And that leverage is going to be tight. It's going to be 65% loan to value. What does loan to value mean? It means to the non-cannabis real estate value. So they're going to take the market rent of a non-cannabis replacement scenario because they're not fully on board. That's the whole issue that we're dealing with today. We don't have a federally insured consumer product that we're dealing with here. So not everybody is fully on board. They're going to play it safe because, they have regulators that are coming in and checking their books, every year, and they want to know that they're lending, safely and with significant collateral. So it's going to be 65% loan to value of the non-cannabis value. That usually comes out, I like to say, on the better end of things, to about 50% of what the person thinks his real estate's worth, hopefully, in terms of loan to cost. It's usually less. I've seen it hit the 50 mark. Hopefully, investors understand or are sophisticated enough to target the properties that actually, match up to the market just to protect themselves from, a leverage standpoint. And then that bumps into the second tier. And I'll get into other variables that you have to keep in mind, which are, the landlord situation, cross ownership between the landlord, the real estate investor, and the actual cannabis company. The tenant himself, hopefully it's, credit worthy. We don't have like investment grade tenant cannabis companies yet, but that's, something to come in the future. Those things are important, and obviously the asset class. So there's industrial, there's retail dispensaries, and then there's super heavy grows and greenhouses, which is just a field. So from a lender's perspective, which, Dennis will get into a little bit more into depth, think about the replacement scenario there. Maybe a tomato grower can come in or some really large manufacturing company with a conveyor belt, but that's about it. So keep that in mind. But then we go into the next tier of financing, which is debt funds. So we're not looking at conventional, financing terms anymore. This is somewhat of a hybrid between, credit unions and debt funds, which are really starting to be more creative. And, the famous debt funds that we all know of, that we send our bridge loans to for commercial real estate, are starting to get into this game. But the loan is going to be like a bridge. It's going to be 2 years, short term, hopefully non-recourse. The leverage might be 70% to the non-cannabis value. But rates are going to be somewhere between 6%, 6.5% to 9%, because they're bumping up the leverage. They're going on a somewhat of a short-term lease. They all typically aren't their own, enrolled, like it's not their own capital. So they have, B buyers to sell off that note too, and they have to make a certain spread. So that's when the rate gets up. They'll be a little bit more flexible when approaching these deals. But, if you're a sophisticated operator at this point and you have a ton of, real estate and you believe in the long haul, like Sandy mentioned, this isn't necessarily appetizing to you. However, there is a large pool of business that this is, exceptional. People about, a year, 2 years ago, when this thing just began, we're looking at rates somewhere in like the 15% as standard. And, that's because, like we learned about, that the revenue is so high. These are trade-offs that actually make sense from an investor standpoint. Just like when, the expenses go up, the income has to go up. So it's a trade-off. But now that things have gotten more sophisticated, we're seeing a lot better deals at the end of the day. And it leads into sort of the third and somewhat of the fourth tier, which is these super creative venture capital funds who, yeah, sometimes they'll do it via sale leaseback, but most of the time they're going to do, heavy pricing. It's going to be somewhere between 12 and 50%. They're going to ask for stake in the company, whether that's licensing, some additional collateral to boost up their value, because usually these deals are coming in at very preliminary stages. It's a startup of some sort. They don't have income happening from any other of their, cross-fertilized properties because they don't have one. This is their first one. They're building the heavy grow, which kind of leads into this whole cycle of, 2 years down the line, they run out of capital. They don't know what to do. Hopefully a great group like Coal Capital comes in and buys the real estate from them, which is their creative way of obtaining funds, which is very common in the sale leaseback world in this industry. But these deals, are seemingly outrageous to your standard commercial real estate investor. But once you get a little bit more familiar with the cannabis industry and you understand all the, the different stages, and it's very complicated, where you are at in your deal, it's not that crazy once you think about it, which is really what leads into like Dennis's world of underwriting. And we all will probably shake our heads and we wish Dennis underwrote all of our deals. But this kind of leads into this unique lending pool of, lenders who are starting to actually underwrite to that true cannabis value. We're only at this point, in my experience, for conventional financing with banks, we've only had access to the non-cannabis value. So proceeds is always an issue. The terms are always, super exciting, but it's proceeds because these guys have large funds, hundreds of millions of dollars worth of real estate according to their revenues and NOIs and cap rates according to the appropriate income. But we don't get to underwrite it appropriately. But, Dennis has an expertise in that area. And I'd hand off the next question to him by asking, how have you seen from your perspective with the lenders that you work with, which is somewhat of a different tier than I'm used to working with? How have you seen that progression in underwriting, and what are the key variables that you consider when you underwrite these types of transactions?
Actually, if you don't mind, I want to ask you a quick question. And with respect to some of the loans, Akiva, that you're seeing, with the 7% and below, are those typically acquisition loans? Are they refis? Are they construction? What type of loans?
Yeah.
So
typically in standard commercial real estate, your average multifamily or industrial or whatnot, those bridge loans you're more often seeing either in the borrowers in a particular scenario where they're rushed to close on an acquisition. Timing is an issue. Their local banking relationships aren't on board with the deal itself in terms of timeline. Usually there's some transitional period where there's not going to be income, light rehab or whatnot. So that's usually when you would turn to these opportunities where it's a little bit more expensive, but the trade-off is the flexibility and the timeline to execute. In this industry, it really matters where you are and what you've done in the past. 7% to many in this industry, I would say 95%. And we're lucky enough, keep on turning back to Sandy because I'm familiar with their fund and the deals. We're used to groups that aren't sophisticated enough to have the real estate mindset, and 7% is a massive win for them. So and then the timeline is either an issue to them because, again, depends on where they are and what they've done. Some sophisticated borrowers actually appreciate the short-term bridge. Why? Because we believe that in 2 years from now, like we said, this whole issue is the nation and not everyone being on the same page. In 2 years from now, we will have everybody on the same page. We're going to have every single bank down the block wanting to lend on these things. And conventionally, I said 4.5% is competitive. Not for multifamily, it's not. But in 2 years in cannabis, when I think, and part of the point of this conversation is to stress that this is coming and it's coming fast. I think in 2 years from now that actually, we are going to be seeing rates sub 4% in the 3% range, and 4.5 isn't going to be considered competitive anymore. So the bridge is actually enticing to them right now.
I think it's important to try and explain to all the folks who are listening in, though, that let's use an example. You got $1 million building, and that $1 million building, that you need to, acquire, very often there's a canna tax, and so now you're paying $1.5 million or 2 million, and then you need to then, of course, put your tenant improvements on. And if you're anywhere in the Northeast with all this limited licensure, that location is going to do 10+ million a year. And so on that $2.5 million out of pocket building, the banks can only give you $700K. So while we say 65% loan to value, it's loan to go dark value or to market rate value, which is a tiny little nuance there. But the point though is that 700K isn't really useful to most. And so when you're looking at, why are we 10, 11%? Well, it's because we can put forth more than the $2.5 million very often on those properties, which they don't have to have any out-of-pocket expense. But Lev's group comes in at another level of the capital stack, and it's like, hey, I just need debt financing. And so all of these factors, we have to go back to the CVS's and the Starbucks of the world. These guys are consummate merchants. They don't own any of their real estate. Why? Well, it was the only way they could get to have 10,000 locations worldwide to be able to keep planting flags and focus on their EBITDA, which is their business. But the truth of the matter is there's just so much capital from many of the MSOs, the operators, multi-state operators that we've talked to. When they open up in a new state, it's so capital intensive. It's typically $30 to $40 million. And so that's what a lot of people don't understand. We're like, oh, Aaron and help someone get a single location, and it is, just trust me, it's a golden ticket. It's immediately worth millions of dollars. And so the time and the energy and maybe $5,000, $10,000, $50,000 of legal expenses and running around over the last year or two to get that license. But very often, what do you see happen? There's this M&A and aggregation in this industry because you just need so much capital, and you have to be able to talk with all of us to bring forth that whole capital stack in order to be able to accomplish your goal. And if your goal is to have a 30,000 square foot cultivation and 3 retail locations, because that's essentially what you need to process your own product and it'll consume your shelves, you'll have $30-50 million in revenue on just that enterprise. But it's going to take an enormous amount of capital to get there.
I have a question for you, Sandy. What do you mentioned the canna tax, which is, just for those who don't understand, when you start getting into cannabis real estate, the prices suddenly go up because everything that touches cannabis becomes worth billions of dollars to the public based on their perception. By the way, as far as the canna tax is concerned, I think that getting in early is the remedy for that. My office is in the city of Costa Mesa, California. The city of Costa Mesa is doing a bunch of dispensaries, no cap. It's a very prominent city in Southern California. And so I'm seeing properties that are worth, maybe 1.6 million, 1.5 million, going into a long escrow for $4 million or more, which is ridiculous. And I wonder how I personally don't get involved with excessive canna tax properties where the premium for the cannabis. I think that when you're purchasing properties, you should try to buy at, as close to market as possible, perhaps with a $200,000 to $300,000 or $400,000 premium, on a $1 million to $2 million property, because you have a long escrow, so that you pay the premium for that. And that's enough of a motivator. But how do you finance? How do the folks on the panel view financing a property that's excessively valued, or the seller's wanting an excessive price because of the cannabis use?
So great question. And quite honestly, the value that you're willing to pay depends on the cycle of which you are entering that particular geography and how limited licensure it is. And so the cycle is, just as you said, there's a rumor that the city council may issue a few licenses, or 1 or 10 or no cap, right? Like, but as soon as that rumor hits, if you're savvy enough to lock up a couple of really good properties that you think, because you don't know, are far enough away from schools and or churches and or parks, or maybe there's a remediation because there's an environmental issue, whatever the case may be, the point is that that property is way cheaper than a year after it's been approved, and someone else is coming in and has the capital to just acquire that property outright. And it still makes sense to pay 2x a year later in many situations. It just depends on where you are in that cycle. And from a value perspective, it comes down to revenue. But then the revenue, again, has a cycle, unlike not too dissimilar than what we referred to with Colorado, where the supply and the demand and the product. But that being said, not to scare James in any way from a title perspective and underwriting, the thought is that when you look at these properties and you look at the revenue and how limited licensure and how slow the licensure is to come online, there's tremendous value in these properties. And we're still underwriting at numbers lower than what your typical CVS would yield. And more importantly, when a CVS moves to a better location down the road because there was some other partner willing to build the suit, or the whole population just moved over another mile or two, and that's the cool hip walk traffic area that the CVS would rather be at, you're left trying to release that to a Family Dollar or Dollar General or whatever, right? And you're getting lower lease rates. In the case from a cannabis perspective, the licensure doesn't easily move. The entitlement itself could take a long time, and therefore that property and the likelihood that you'll roll over into a new term on that lease is that much higher. And so these properties have tremendous value, tremendous long-term potential. There will be very much a forced appreciation once the banks approve, or excuse me, the SAFE Act is approved. And so not only we're very bullish, we've seen it. We've seen our thesis play out over the last 3 years.
Yeah, and I'll just transition it because there's so much to say about that. And like Sandy mentioned, the golden ticket and the tremendous value that we all consider the entire, communities, and especially from your perspective, Aaron, whatever they touch, it's gold now to everyone today but the banks. And for that, I think they're a little bit behind. While as, some of us, and I think Dennis could shed more on this as we segue into more of his expertise, is that, there are lenders that actually are ahead of the game and are considering the true value here. So Dennis, in light of in the legality in California, at least medically, can you shed some light on how your lending perspective has evolved in the past year?
Yeah, so it's really, and probably even more than the last year, it's probably been about the last 4 years. I think that was probably the first cannabis loan that one of our clients actually extended. That was back in the days before adult use was approved in California. But yeah, there's been a huge evolution of just the types of loans that we're seeing, as well as the types of loans that our clients are willing to extend. I think kind of first off is to look at the type of borrower that you see now, as opposed to 2 years ago, even when California had adopted adult use. At that point, you saw everybody and their brother trying to jump into the game. If they knew how to grow cannabis, they had no business acumen. They were still looking for money. They were still trying to acquire property. Back then, I had a couple of friends of mine that we had talked about, and he actually had a background in finance. And he said, "Look, Dennis, here's what's going to happen: is you're going to actually start seeing larger funds, a lot more capital backing it, and rather than being cannabis, marijuana type people that were historically associated with medical marijuana, you're going to just see regular business people, CEOs, and people that are interested in that have finance expertise and not cannabis per se. And that's a lot of what I've seen on our end. Is I don't get as many calls, and I still do get calls from prospective borrowers looking for a loan, and usually it's not from the guy going, hey, I want to open up have this property over here, I want to acquire this property for the purpose of opening a dispensary. Now it's more of, we have a fund or a large group, a joint venture that is adequately capitalized, back behind it, that's either looking to expand what they're doing, or just looking for a little bit of extra help to kind of get them up to that next level. And we're not talking about small grows, we're not talking about small even dispensaries. These are quite large. It used to be the average loan was about maybe 750,000. And it really capped out at about 1.5 million roughly. And now 1.5 is actually a rare figure to see. We're seeing 10 million, $15 million loans that are going out there. Now the one thing that is really interesting, and I find really exciting, is we also have a group of lenders that we work with, as you had mentioned, Akiva, that aren't just stuck on the value, the non-cannabis value of the property. That was always the advice I would give our clients, before, but now they're really pushing forward. Obviously, if we're looking at non-cannabis value, or using cannabis value, you're not going to get the same type of pricing as Akiva had mentioned, because there's a higher risk to the lender and the investor as far as dealing with an operator who, there still is a chance that it doesn't pan out, or even if they do well and they do succeed and maintain their business, it may not necessarily, it's not going to be that type of returns across the board for everybody, especially as this market continues to shake out, and as you see more cannabis businesses aggregating and joining together. So, but it's really interesting because our clients do lend based on cannabis value, and we're seeing anywhere, actually it's not too much higher, maybe like 9 to 12%, and probably about 3 to 5 points up front. But again, it's cannabis value, and a lot of what I'm actually seeing as well are industrial properties as opposed to retail. And so with respect to the industrial properties, they need a significant amount of revenue to build out and to actually accommodate the grow. So when you take into account, if you have a lender that's willing to cover that extra kind of $1 million, or at least a portion above what Sandy had mentioned, the $700,000 non-cannabis value, loan to value versus $2 million of what it really costs to get started up. Well, my clients are, I've seen loans now where they're lending 1.5 on it, so or 1.2. But again, the cost of what you're looking at is going to be greater because the risk to the lender is greater, because you not only have the cannabis side of it, that the property is going to realize the value of what everybody believes it's going to, but you also have the construction side of it. And for anybody out there that has worked with construction lending, sometimes it doesn't go as planned. And so you're mixing a lot of fields into a single area right now, where you really need a lot of people on board that have the expertise in cannabis, in finance, as well as that actually know how to construct and build out and price things correctly. And so underwriting becomes very important in understanding what that project looks like, what the expectation is. And so oftentimes, I've actually seen now where lenders are introducing equity or kind of pseudo equity aspects to their loans, whether it be convertible debt or options to just straight options in the operating company, or even outright equity assignment to either, usually it's an affiliate of the lender where that assignment goes, but it's just an outright equity assignment. So lenders are becoming, especially here in California, are becoming much more comfortable with the idea of cannabis. And so they're kind of opening up their playbook, so to speak, things that we've been doing for years with non-cannabis loans, and looking at construction or development projects. We're now able to introduce into cannabis with some of our clients and lenders in general that aren't quite as risk adverse and that feel comfortable with the cannabis space, knowing that, okay, well, I can step in here, I can take it over. Now everybody has a guy or knows somebody, a fund or, that would be able to come in and step in it. For instance, if there needed to be a foreclosure, they could have somebody that could step in and take over that place. I know I've taken up a good amount of time here, and so I kind of apologize to James. I think I'll kind of leave it at that, just knowing I'm excited where this industry is going. And I love seeing companies like Aaron's, like Sandy's, and like Akiva's that are really pushing things forward, that are doing it in a very sophisticated and professional way that's going to help grow the industry. And really take a perception of where in the past people have looked at marijuana and have kind of been like, oh, slackers, who's going to deal with it, to really where you have trained professionals, people that know their business, know what they're doing. And as a result of that, I think for years to come, that this industry is going to continue to grow. And then once it gets legalized at the national level, it's going to be really crazy to see what's going to end up happening. Right now, we're still kind of in the Wild West phase.
Well, to address one of the questions that was sent to us, they were asking, you didn't really address the Fed versus state issue. It's not a question of if, it's a question of when. We've heard it from many insiders in Washington, D.C. It truly is not a question of if, it's a question of when, especially now that both houses are blue.
Yeah, and there's even bipartisan support for it as well. So I think last week or 2 weeks ago, 2 Republican representatives actually introduced a bill to deschedule cannabis, which is obviously what everybody's hoping is going to occur, and not a rescheduling. I really don't think rescheduling is even on the table any longer. So I know that bill was introduced. I know that there's another, I think pretty soon, an additional Senate bill is going to be introduced as well by the Democrats, which is really similar to the one that's been introduced in the House. It's just the difference. One of the primary differences is that the Democrats are including kind of reparations for individuals that were operating legally under a state's cannabis licensing regime, and giving them some sort of reparations. I actually know an individual that was in prison for 8 years that was engaged in legal medicinal cannabis. He had a dispensary here in California, and he ended up, they made an example of him, and they just pounded the guy into the ground, and moved him to a higher security prison out of state, away from his family and everything. Oh yeah, it was absolutely wild. But fortunately, that is not something that I have not really heard anything even close to somebody that's operating in compliance with the state's licensing requirements that have had issues. The only times now where the federal government really steps in is instances where it's an illegal operation. For instance, in Central California a few years back, we had a bunch of an organized crime syndicate from outside of the US bought up a bunch of single family homes, converted them all into grow houses. And so at that point, the federal government stepped in. But it's not, again, obviously, it's a crime syndicate and not a licensed entity. So you just don't see it. I haven't honestly, and I don't know if any of you have seen it in the last, I can't even think of, from a license standpoint, probably within the last 2-3 years at least, maybe even 4. I've kind of stopped even keeping track of that because it's just not even a topic that comes up.
Mark, I see we're running out of time here. Obviously, we're due for a part 2. There's just so much to cover. Do you want to, say some final words, or if there's anything, James?
No, I want to. Yeah, let's go over to James, just to talk about how title insurance is such an important part of the real estate any real estate transaction. So James, tell us about what you're seeing with real estate cannabis in terms of title insurance and where you think that's going.
Thank you, and what a great panel. I learned a lot actually from this panel today, so thank you. Look, we're evolving. Initially, a few years ago, we wouldn't touch any of these kind of policies. We would not insure them. We have insured a couple, not recently in other states, but with exceptions for any lack of compliance with federal and state laws, regulations, etc. And of course, we get criticism for that because nobody wants the exceptions. And now here in New York, right, adult use is now okay. And there was a recent transaction in Riverhead. It was a cultivation site that a competitor insured for $42.5 million. So we do see this thing coming along. And like Akiva said, in a couple of years, it's all really going to be a moot point because everybody's going to be on the same page. So where we are now with corporate is we're at the stage of it. When do we insure these without exception? That's the key component. We've issued policies with exception, but can we now do it without exception? And that's what they're weighing. And like you said, you made a great points about the lenders and how they're all slowly coming on board, and the Safe Banking Act. It should be a slam dunk, I would think, at this point. So like I said, it's coming together and it looks optimistic for title insurance. It's great revenue for us as well. So, I mean, that's where we are in short terms.
If I may, James, can you kind of just describe what type of exceptions right now you guys are insuring under?
Basically, it's one big exception, and it talks about, they accept any loss, claim, or damage by reason of the land use being deemed non-compliant with state and or federal rules, regulations, etc. So it's an all-encompassing exception, and they are, but they're not happy about that. The clients are like, what does this really mean to me? So now we're at the stage where we want to get past that. And I wish I had good news today. We're not there yet, but I think we are almost there. And I can't speak for my competitors, but I think everybody's working on it behind the scenes. And I think it's going to come to that point.
So
doesn't the policy already kind of cover that anyway?
Yeah.
And accept those items anyway?
They look at this as an extraordinary issue. So if it's an extraordinary issue, we really have to actually focus on it and not just rely on the policy jargon.
Fair enough.
They want to make sure, because if they get a claim on it, I don't know, I'm not sure they know how to handle it yet.
Fantastic. So I guess in terms of timing, that pretty much wraps up the time. Does anybody want to just jump in here with any last words, or is there any outstanding? I know looked like there were some questions from the audience. If there's any, we have a few more minutes. So if anybody wants to just jump in here.
Mark, read one off if you have one in mind in particular.
All right. We have Matt Ryan here with Colorado Land and Mineral Company. Oh, no, that wouldn't be the right question. So here's one. Aren't traditional banks concerned with the prospect of making loans to MRBs and accepting deposits violates federal law, potentially subjecting the lender to enforcement actions by federal banking regulators or criminal law enforcement agencies? Thanks. I believe we discussed that.
James,
yeah, and this, did somebody else jump in, or I can?
I think this is perfect for either James or Dennis.
Yeah, so that is their concern. FinCEN has released guidelines with respect to dealing with MRBs, but at the same time, the bigger concern is not so much the filing the SAR reports and other things like that. It's really, from my understanding of the issue, it has to do with the federally insured side of it. And that if one of the FDIC insured banks is kind of caught being dealing and working with the cannabis industry, that they stand to lose that FDIC standing. And it's not so much because there are, right now, there are local credit unions and local banks that are, complying with the reporting requirements. There is extra work to do on that end of it, but it is possible. But again, I think it's more the FDIC side of it and the fact that it's federally illegal itself than the financial reporting, because there are guidelines set up to allow that to happen. The good news is either within one of the bills that are being introduced that I had mentioned earlier, as well as there's also the Safe Banking Act as well that is about due to hopefully get considered again here, that would protect banks from any type of penalties or anything like that if they provide services or loans to cannabis businesses. And you also have, just interestingly, from an insurance standpoint, there's a companion bill that actually clarifies the Safe Act for the Safe Banking Act that extends that to insurance companies as well.
All right, let's go to one last question, and this is actually kind of interesting. Can you ask? This is from Eric Sauter. Sorry if I'm pronouncing your name wrong. Can you ask about intercreditor agreements? It seems companies need a lot of capital, and the licenses are highly leveraged. How does that play out, and how does the capital stack generally agree to play in the sandbox? It's a great question.
So if I may, it's a complex question, right? So in our case, we're doing a sale lease back with an option that if someone wants to buy the building back, right? And so that typically is set up as an SPE. And so that special purpose entity is a business unto itself, and therefore we don't need to, but sometimes they have an umbrella line of credit, warehouse line of credit, debt instrument for the entire organization. And so they'll need to get a carve out for that SPE, or there's just so many different scenarios. And quite honestly, there's no one size fit all question, but I guess I'll let Akiva comment more.
Yeah, I mean, I could just speak from just particularly in standard commercial real estate, just to clarify for listeners. A scenario where that would play out is when you have a first mortgage from a bank per se, hypothetically and optimally from a bank, which is the first note, but it doesn't get high enough on the capital stack for you and your investors to feel comfortable in the acquisition. So this happens, with hotels, it happens with multifamily projects, but very often it's necessary for these because of these inflated acquisition prices. So if we're looking at a property that's, 100,000 square feet, it's state-of-the-art facility, but nonetheless, non-cannabis value, let's call it 5 million, but the purchase price is 60 million because of its value with the revenue and, the cannabis operations happening today. It's hard for investors to get on board with, a loan to value based off 20 million, getting a $13 million loan on that type of acquisition. So what happens is ideally, back to traditional real estate, you would bring in some sort of secondary financing, like a mezzanine loan or pref equity. That's how you complete that. You fill the gap or the void in the capital stack. So obviously that's going to be more expensive. They have second position to the collateral. Their risk is higher, therefore it's more expensive. So this was really not an option, at least for conventional financing for cannabis a year ago. Today, just for context, we're working on a deal in Massachusetts. It's about 250,000 square feet. It's an industrial property, similar numbers to the metrics I discussed before. There's a huge void in the actual value of what the bank's going to get to on 65% loan to value of non-cannabis. Let's call it's going to get to about 30 million, but the acquisition price is 50 million. So it's just not high enough on the capital stack for our borrowers to come in and make that acquisition. That being said, that first note is at 3.5% or 4%, call it 4%. So there is some room here in the industry for you to add a mezzanine loan for this second position on the property with a higher rate to somewhat fill that void. There is the trade-off of the blended rate coming into something like 6.5 or 7%. But if you're able to bridge that interest only for 2 years on that second note, again, you run the numbers and the analysis, the trade-offs, it's there. This is still a great deal. So to get an additional $10 to $15 million, which really bumps the capital stack to what was 40%, loan to cost now that we're considering it the true number of loan to cost. Now we're at 55-60% loan to cost. And I'll tread back on an earlier point, which is what we've discussed about this whole leverage perspective. it's a matter of two things. It's about expectations, truly, and the market that you're in. Yes, one route is to target, assets and properties that are in a particularly strong neighborhood or market for, non-cannabis replacement scenarios, and those exist. I mean, I would say in the next 2 to 3 months, you're going to see a full grow next to an Amazon facility. So there's that great hype about the non-cannabis replacement scenario, and you're going to see some real value in your appraisal. And again, Dennis mentioned something. Sometimes there are five values that end up being appraised. There's the non-cannabis value, there's the go dark, there's the as completed. It's super complicated. But the other option is, which is what we're familiar seeing on these larger deals. And that's where the void gets bigger. When it's the bigger the deal is, the bigger the facility, the more of a premium and inflation of money actually is on site, per square foot. We're not dealing with $100 a square foot. We're talking about $300 a square foot. So there's this huge void in value. The other route is perspective and expectations. So a lot of the borrowers that we deal with, which are like REITs and large funds, they understand that the industry is not there yet in terms of competitive financing for their capital, for their large, amount of money that they put out to these allocated properties. So they're happy taking out 30% loan to cost. And it's no need for that secondary, position, that mezzanine loan, and getting higher in the capital stack. I only see that necessity for getting higher in the capital stack as like I need to commit to this and, bite the bullet and pay that more expense. If you're in a tricky situation on an acquisition, it's more of a one-off type of deal. But when we're talking about big institutional groups, which are really getting more involved in this space, it's not necessarily something that borrowers consider, because their investment when they started this thing a year ago, and maybe Sandy could shed more light about this, when they were pitching out these books, yes, they did have, at the end of the pro forma 5 years down the line, expect some nice looking refi with a conventional bank at 3.5%. But I would venture to suggest that most of these groups anticipated going all cash for the next 5 years. And that's very common. And then when groups like myself come in and say, hey, you've put out $100 million in cash, how do you feel about taking $30 million of cash fresh for 4% and allocating that towards your next purchase? And they're all ecstatic about it. It's low levered and it's a low loan to cost, and it seems bizarre, but in this industry, it actually makes sense.
For sure.
All right, everybody. So I guess that's going to wrap it up. So thank you all. This is an amazing panel. I've learned so much. And thanks again.
Thank you, Mark.
Have a great afternoon.
All right, bye now.